one of my mentors who became very, very wealthy, just buy and hold, and he never sold. And he did this for probably 70 years. He became a multi-billionaire and he started with nothing. Like, he kept telling me time and inflation are real estate's best friends. And now I totally understand why.
Hey everyone, welcome back to the Real Estate 101 podcast. As always, I'm your host, Robert Leonard, and with me today, I have Keith Wasserman. Keith, welcome to the show.
Yeah, thanks for having me.
Yeah, I'm excited to have you here. I want to start out our conversation today with a topic that's been in the news a little bit lately, at least for those who follow real estate and venture capital a bit, and that is Adam Neumann is raising money again. And for people who are familiar with the name but don't really know what he did, he was the founder and man behind WeWork, and he's been in the news because of all of that money that he raised for his newest ventures. Break down for us, for who hasn't heard the news, what's going on, what he's doing, how he raised capital. Basically, just break down everything that's going on with that story.
Yeah, I mean, I think you know as much as I know, as much as everyone else that's not involved in the transaction. I put out there on Twitter if anyone has any inside information to slip into my DMs. But essentially, there's just a lot of ideas on what's going to be done, and you can read what Mark Andreessen put out there, and it is definitely a big swing. But you don't know. Is the $350 million, does some of it go towards any purchase of real estate? I mean, which is really capital intensive. If it was straight into a newly formed entity that hasn't even started business yet as a pre-seed round, sure, that's, pretty impressive and crazy. But, WeWork, I think all the early investors probably did well with it. I mean, all the subsequent money that was raised later on got hosed, but yeah, I'm just as curious as anyone else, what's the actual business model going to be? I do think there could be some more, innovation in the multifamily space in terms of the technology used and maybe the way we think of, housing as we know it. And look, Adam Neumann didn't create the co-working concept. That was being done, by multiple other firms, but he made it sexy and cool. And, he established a brand, and it became, just at the tip of the tongue. You want to, come to the WeWork, or, one of our startups I was involved with, we were in a WeWork until we outgrew it. But I definitely, like the concept, and maybe he's going to do something similar, in the multifamily industry to, create a brand. And, I was reading about, maybe some kind of way for apartment renters to gain ownership in their property, which would be, unique. Rent to own is not totally new, but maybe he has a different mechanism for it involving crypto. Who knows? There's a lot of speculation, but I'm interested to see what he has to do in the space for sure.
He did get a lot wrong with WeWork, but he did get a lot right too. I mean, he did kind of make WeWork the name as like synonymous with co-working space, kind of like Airbnb or Velcro. People don't know that Velcro, those little strips that connect together, that's not actually called Velcro. That's the brand that's behind that. The actual like technology is called hook and loop. And so he did kind of the same idea with WeWork. But I'm curious from your perspective, as somebody who raises capital for your real estate deals, and just knowing how important it is to vet the sponsor and for the investors to be confident in the person that they're investing in. What do you think about somebody kind of still backing Adam after everything that happened with WeWork?
Yeah, I mean, look, it's obviously, Mark Andreessen being, contrarian. It's a big bet. In the VC world, they like backing repeat founders. Look, WeWork does have a current market cap of around $4 billion, and it, at one time, 30 or 40 billion. I think it was just bad governance. I think they just grew way too fast. I know people in the co-working space that, have done very well just with a smaller platform. They don't have as many offices, but it's very profitable business for them. They started it. Actually, they acquired a bankrupt company during, I think, the last downturn that was doing this kind of co-working spaces and, executive office suites, et cetera. So I think, backing someone, if he has a chip on his shoulder, and sure, it's a lot of people are like, oh, you need to back people that are, from scratch, that don't come from these backgrounds, but he's got away with, charming people and creating a business, and he willed it into a worldwide company, this WeWork, right? And even though, a lot of early employees got hosed and a lot of investors that came on later got hosed, it's still a publicly traded company. And TBT. I think it's, $350 million bet. You don't know how it's structured. Like I said, how much is going towards any real estate, how much is going towards a new venture, what kind of controls the investor has. And it's out of a multi-billion-dollar fund probably. So even if it does go to a zero, it's still a big swing and it's not going to affect it. When we're investing in real estate, we can't have any zeros. We're all about preserving wealth and growing it safely over time. And, if it's done out of a large fund, if it's a small percentage, then they could take those kind of swings. But generally, when a company gets so much so early, I haven't seen any real big successes. It reminds me of like Quibi. They raised like $1 billion right off the chute, and they had big names behind it. And sure, the concept might have been good, but there's just things just generally do better organically, starting smaller and growing momentum and compounding over time versus just out of the chute going big like that.
There's a book, I don't know if you've ever heard of it. You've definitely heard of the author, but Damon John, the shark from Shark Tank, he has a book called The Power of Broke. And he talked about in that book how people who are broke, and he extrapolates it to companies too, and how companies with a little bit of money, if they figure out a way and they get hungry and they find creative ways, and that helps them, versus people that are just starting with a ton of money, or companies that raise a ton of money. They actually are often at a disadvantage because they just don't have that kind of like chip on their shoulder.
Yeah, and they're not as resourceful and stuff. They just throw money at it to solve issues when maybe there's no real product market fit, or maybe, they got to figure out a way before they start, pouring the money on the fire to make it bigger. So for sure.
Yeah, exactly. The listeners of the show who have been around for a while know that my background before getting into real estate investing was studying the stock market, and that I'm a huge Warren Buffett fan. If anybody's watching the video, a lot of the books on my shelf behind me are Warren Buffett books. This seems to be a bit of an uncommon position, at least from my experience in the real estate world. But I do see you tweeting about Charlie Munger and his principles pretty frequently, especially recently. How have Warren and Charlie's philosophies impacted how you do business, and how do you apply their business and investing principles to real estate?
Yeah, I think, a lot of people in our space, these syndicator groups, are looking for the short-term 1 to 3 year kind of fix, flip, return capital. It's totally like the finding a great company and buying it at a good price and holding it long-term kind of thing. So I try to apply those principles now to real estate, where we're buying, A+ real estate and at, very fair kind of prices. Yeah, Charlie and Warren are angry about how people are just flipping, properties. It's like day trading, right? It's like, why sell the golden goose laying the golden eggs? Especially if a market has high barriers to entry, and just it keeps improving with population growth and job growth, and the replacement cost just keeps getting more expensive to build. Why sell something? Instead, just keep holding it, and then refinancing and pulling out money, tax deferred. It's more tax efficient. You don't have the long-term capital gain plus all the recapture. So yeah, I try to apply those kind of principles from just the buy and hold mentality, which I didn't really understand until like later on in life, about the power of compounding and how just holding long term, and everyone wants instant gratification, and it's really all about just staying at something for a long period of time, doing it over and over, and in 1 year 20% doesn't sound it's 20% doesn't sound like life changing, but if you do 20% for year over year over year compounding, then you'll be as rich as Buffett, because that's literally what he's been doing, like a 20% CAGR for 60 plus years, right? So it's just really interesting to me, the power of compounding and long-term thinking.
Let's dive into that a little bit more. A common thread throughout your online presence, whether it's your Twitter bio, company website, or even what you tweet and retweet, it's that you compound, like you said, and that you think long-term. A lot of the listeners of this show are newer investors, and I think they're often struck by shiny object syndrome, and they bounce from strategy to strategy in hopes of getting rich quick. How did you shift your mindset from getting rich quick to building wealth slowly? And how would you help someone who's currently struggling with this dynamic in their own life?
I mean, I've made all those mistakes, right? Like, I didn't understand it early on, and I bought public companies that, I wasn't planning to hold my life. Like, if you're not willing to hold it for a long period of time, a decade, 2 decades, multiple decades, then why buy it at all, right? Like, so I've made that mistake. And with real estate, we bought stuff just because it was cheap. Doesn't make it a good deal and stuff. Like, I've done that mistake too. And, I think I've just learned from mistakes. I'm lucky that I started investing in, my real estate business very early in life. So now I still have good amount of runway left to fix these mistakes and hopefully teach, my children about, it's all about shiny object syndrome. And for sure, I've done it. I've made a lot of those mistakes myself, so.
You mentioned that you're a big fan of compounding, but it seems like to me that this term or the idea of compounding is thrown around pretty frequently. You see it on Twitter a lot, but I don't think it's really rarely explained for newer investors. So for those listening who might not know exactly what you mean when you say that you're always trying to compound, explain what it is and why it's so powerful.
So literally someone asked me the other day the definition of compounding, and I couldn't even really explain it in words, but I showed them a chart of like something that goes like this at a steady rate of motion to something that sort of hockey sticks with time. So like compounding, the easiest way is monetarily with money. Like if you showed like 10% per year non-compounded, it's the same dollar amount you're adding every year. But if you do 10% compounded on the previous year, if you're doing it just starts really over time skyrocketing. And it's hard to even imagine compounding. Like I literally had to sit with a calculator and I didn't even understand. I didn't even believe it. I'm like, what if someone starts with $1 million, which is a lot of money, but if someone starts with $1 million, doesn't put any more money into it, if they're able to hit that 20% per year, which is like extremely hard to do over a long period of time, I think it was like 35 years, they become a billionaire without adding any money to it, which was just mind blowing to me. But it starts slow, like, 1 million to 1.2 to, I don't know, I can't do it in my head, but it's like, it starts sort of like this and then goes, and that's what my career has been like. It took my first 5 years. I still lived at home. I had very minimal expenses, and it was sort of by design, but also by necessity. And like, I'm glad that I didn't spend much of my early monies. And that's the benefit of like starting a business early. You want to keep your personal burn rate really low and sort of, run your family and your expenses, like, to be perfect for compounding, like keep it really low and earn more than you spend kind of thing. People they start making money and you have lifestyle creep and like all these things happen. But I think the trick is just keep making more money than you spend and investing it at the highest rate of return, risk adjusted and for a long period of time. The earlier you start, the better. You got to just play around with the calculator and look at compounding graphs and you'll see the difference. It's remarkable. And it could go the other way too, compounding the wrong way, like reputation compounds, right? Like I never understood that until, my dad's always like, your reputation is so important. It takes 1 minute to knock it off, like a lifetime to build. And now I understand like every little thing I've done, every person I interact with along the way, like it just builds your reputation because that person then interacts with 50, 100 other people and that person, and like you could pretty quickly build a pretty good or pretty bad reputation based on how you act with people in this world,
How do you apply that in real estate with your real estate investing approaches?
Yeah, it's totally like dealing with the brokers. We're buying buildings that are generally 200 units and up in maybe 4 core markets. So there's maybe a few dozen brokers that are actively marketing our deals. So just having a great reputation as a closer and a performer and someone that doesn't come in and retrades. And, we want to be at the top of the list when these brokers are marketing deals or not marketing. Maybe the seller allows them to bring them to a few groups off market. We want to be at the top of that list for the brokers. And the same goes to the sellers. Like there's maybe 1,000 groups in the country that are constantly buying and selling these larger apartment communities. So just building that reputation. Maybe I for sure haven't met all 1,000, but I've met probably at least 100 of them. But they talk to their peers and like, we want to just be known as the preeminent buyer of these kind of properties. And, I didn't understand it completely. Like I started buying mobile home parks and doing some other VC stuff. And it's like, if we would have just focused and not done these other things, sure, we made money on them, but it didn't go towards compounding our reputation in the industry and knowledge in the industry. And like, just focus, I've learned over the years, is so important. And now I understand why, like, Buffett and Munger, they'll look at hundreds of pitches and only swing when the real fat ones come and go big and concentrate on those. And it's the same concept of just concentration and focus and not being distracted for the compounding,
You recently tweeted that time and inflation are a real estate's best friend, which you then followed up by retweeting a tweet from Jonathan Barr that said, and I'm going to read it real quick, I made more off 3 properties that I held over 10 years than my share of the profits of 400 flips during the same period with a fraction of the effort. Holding long-term is powerful. I've had some operators on the show who hold or own assets similar to yours, hundreds of units, but they only hold them for 2 to 5 years. and then they sell them because they've achieved, and I always ask them why, and they say it's because they've achieved their target return. They can return the capital to their investors and they're happy, and so they sell them. And I can see the thought process behind that, but it always struck me as odd, kind of like you said, is that they would sell a great asset. They have to redeploy that capital into something that's relatively unknown, and you already have an asset that's performing really well. You know it well. Like, it just kind of, there's a little bit of a disconnect there for me. So how do you think about this, and how do you typically manage your hold periods with your real estate portfolio?
That Jonathan Barr quote was really eye-opening to me because, I know him personally, great guy and stuff, but and I've done some of that too, where you flip 400 flips, he would have made the same amount of money as just holding 3 deals or whatever. What, like you said, it's pretty just eye-opening, just that time and inflation, are real estate's best friends. And one of my mentors who became very, very wealthy, just buy and hold, and he never sold. And he did this for probably 70 years, from 20s to 90 years old till he passed. Like, he became a multi-billionaire, and he started with nothing, like literally cleaning. He was a worker that cleaned construction sites, and then started his own cleanup crew kind of company to clean up construction sites, and then started investing in little tiny projects, and then building a little bigger buildings, and then a little bit bigger, and buying a little bigger, and just kept pushing the envelope. And like, he kept telling me time and inflation are real estate's best friends. And now I totally understand why. And yeah, it's tempting to think like, oh, in a few years, I totally renovate the building and I achieve my business plan. I hit a great IRR and whatnot. But the IRRs could be great, but in terms of multiples on the money, it's like, if you just hold long term, if it's a great property and you're taking good care of it and it, like, it's better just to hold it longer, and just keep pulling tax deferred monies out. You have to like literally hit a way higher return or to get back to where you were. So it's like selling a stock that's appreciated, right? Instead, just borrow against it, and you can write off the interest. And it's just, if you do it prudently, you don't want to lever up like crazy. But yeah, I mean, my dad's owned stock in like Nike for 20 years. He put like, I don't know, 10 grand in it, and it's worth like 200 grand now or something. So it's the same thing, compounding, buying great companies and for a long period of time. And yeah, the trick is how to identify those great companies. So I just met a great young man named Jake Davidson that I'm pushing off I have stocks in my SEP IRA 401k, and I'm going to open up a small stock account. Being a real estate guy, you're never that liquid because you're always putting money into real estate, which then locks it up. But like, every additional dollar I want to earmark to the market, I'm just going to give him, because all day he just reads like Buffett. He's reading about companies, all the, whatever you call them, 8Ks, 10Qs. He's going to the on-site visits with the management, or going to the stores himself, like constantly reading. And he picks like 16 companies, to invest in. And every year he maybe peels off one or buys one, and I think that's the only way to like beat the market. Otherwise, most people are better off just buying the index for the stock market. And that's great if you could compound at that 8% per year. But the problem is most people get emotional. They sell at the wrong time and buy at the wrong time. And that's why they don't even hit the market returns.
You founded your real estate firm in 2008. I found this really interesting. You founded it in 2008 during the height of the recession and the financial meltdown. Why get into real estate at exactly the point where it was one of the most hated asset classes? And going back to what we've talked about throughout the whole episode so far, is this related to Buffett and Munger and how they always talk about being greedy when others are fearful? I know you didn't necessarily know their concepts yet, but now looking back, are you thinking that's maybe what was happening there?
Yeah, 100%. I mean, the margin of safety is so great when something's so depressed. There's nowhere to go but up, literally. I mean, it could have faltered a little more, gone down a little more. Sure, you can never catch the bottom, but things were so depressed and blood was in the street. And that's, the best time to start a business, to buy something, to get involved in something, like when the expectations are just so low, right? And there's nowhere to go but up, right? Like when you hit rock bottom or something, there's nowhere to go but up. Same thing. Yeah. It's the real estate presented an opportunity to me and my cousin, and we sort of pounced on it, and not knowing, in my lifetime, that was like a really good entry point. And, I think it's cyclical. Eventually it's already happening. Prices are down right now, 10 to 25%, depending on what the property is and where in the multifamily space. So right now we're taking advantage of that and starting to make some acquisitions. We paused for a little while to see what's going on, like everyone else, kind of with the interest rates rising so fast. But for long-term holders, this provided a nice little entry point. We're buying a deal right now in core Southern California.
I want to talk a bit about that process of buying from a publicly traded REIT. But before we get to that, I'm curious, what was your experience with real estate prior to founding your real estate firm? Had you owned any rental properties or done any flips personally before you got started?
I was always been an entrepreneur. I've never had a job. Literally, my dad set me up with this like big developer in town, the guy that said time and inflation are real estate's best friends. And I didn't make it. Literally, I call my dad. I'm like, I can't do this. I don't mind pushing papers and filing for myself for my own business, but I'm not going to do it for someone else. And he said, at least finish the day. And I left it when I went out for lunch. My dad's an attorney by trade, but him and my mom built this little strip center here. They invested with a few of my dad's clients that were in real estate, so like tangentially understood about real estate. And my dad knew, he was smart enough to know that he's made more money in real estate than his law practice. Even though he had 80 attorneys, literally, I just learned by doing. Damian, my cousin and business partner, his dad was out there in Bakersfield buying and renovating like 5, 6, 10 unit kind of small apartment buildings, and just very hands-on himself, like literally walking the building with the contractors. And that's how we learn. And Damien, we were driving out there every week, 2 hours each way, and paying all the people that were working, inspecting the work, and literally just being very hands-on and learning the business by doing. That's the best education. People always ask, is it better to do that? Is it better to get a job? It just depends. A job is great because you get paid for learning, sort of, right? But I'm unemployable. Like I just can't be an employee. I'm too can't do it. It's not in my genes. So
let's go back to the publicly traded REITs. I'm curious to learn a little bit more about that. I don't even know anything really about the process. I guess I don't even know truthfully what questions to ask, but I guess just tell us a little bit about how that comes about. Do publicly traded REITs list their properties with brokers only? Do they go to market? Like just walk us through that whole process.
Yeah, and I just learned this myself. We haven't bought from that many REITs, and they sell generally when their stock price is down because they use those proceeds to buy back shares. So you see that with a lot of companies that are well run. When their stocks are down and they think it's a value, they'll reinvest in buying back shares versus spending the money and giving dividends to the shareholders. So right now, the market's down, and they're peeling off a lot of assets in different markets. So this one happened to be in one of our target markets here in SoCal. It's a 2009 build asset. It was institutionally built, institutionally owned. It's in great shape. And yeah, I mean, generally, like, we're a big player and stuff, but these kind of buildings generally go to other kind of REITs and stuff, but they're sort of out of the market now, and it leaves opportunity for entrepreneurial guys and gals like ourselves. I remember when we started in Phoenix, they were selling everything in Phoenix. Equity Residential was offloading all their portfolio in Phoenix. And generally, that was just a really bad time. People like ourselves, we bought, few from different REITs, but everything that was bought during those times have gone up so much. They weren't the best at timing it, but maybe they bought back their stock, like I said, maybe they used those monies and bought back the stock. Maybe the stocks perform. I haven't really tracked it since 2010 to see how it's done, but they market it just like anyone else with the property, and they brought it to market, and we have great broker relationships, and we're very lucky to have been selected as the buyer, and we came in with very aggressive terms and a market price, a fair price. And at these big price points, it's hard to like steal a building from mom and pop. Once in a while you could buy something but with the internet and all the information, it's all out there. You got to either be long-term thinking or see something that other people don't see, and really to create that alpha. Same in the stock market. It's like there's no asymmetric information unless you're insider trading or whatever, right? But all the information's pretty much readily available, but you got to just have a long-term mindset or see other things that other people aren't seeing.
I think what we're seeing today is pretty far from the financial meltdown of 2008, or at least it has been so far. But having been through that time, how did the beginning stages of what we're experiencing today compare to what you saw back then?
I remember back then the stock market was falling every day, 500,000 points. Like, it was just in such turmoil. And I guess we are down now pretty heavily, like on the NASDAQ, but you could have said it was maybe overinflated. Back then, I remember reading the Wall Street Journal every day. I opened it. You see 10,000 job losses, 20,000 job losses. Like, I see some companies that, are sort of aren't profitable and stuff. Yeah, they're the tech guys. They're laying off a few people here and there, a few hundred. It's nothing like I saw back then. And unemployment right now is like historical low again, I think, right? Didn't it go back to, during COVID, it shot up because people couldn't go into the office and work, and things were shut down. But I'm surprised how quickly it bounced back. And I think the economy is just too strong and too hot. And that's why they're trying to curb the inflation and really, rise rates and slow it down a little. And I think it's just a totally different thing than what I was seeing in, '09. I'm 37, so I don't really see I was 6 or 7 when the early '90s thing hit. So I don't know what happened exactly back then. I mean, I could read about it, but I wasn't there to see that distress and that crisis. And, but every 10 years there's some kind of fallback. But like, if you have the dry powder and be able to withstand those downturns, the next high will be much higher, and those downturns will be great buying opportunities.
Some of the markets that you're invested in are a bit unique to me, at least based on the previous guests that I've had on the show and kind of where I invest myself. Many of the guests, even those who are similar to you and based in California, they invest in many of the same markets in the same states, which include Texas, Florida, the Carolinas, etc. A few of the markets that you're investing in that interest me are New Mexico, Washington, and Utah. California interests me a little bit too, but mostly those three. What made you pick those markets? What are you seeing in those markets that make for a good investment opportunity?
Yeah, so we're so opportunistic. We're market driven. Once we pick a market, we then go heavy and try to buy at least 1,000 units in that market. So we started in Bakersfield in December of '08 or '09, because we saw the opportunity to buy stuff very depressed, and the industry was based on oil and agriculture, which we thought would come through really nicely through the recession. Oil was still like $130 a barrel, and they did start adding tons of jobs. And we looking back, that was actually a good market in the beginning. And then Phoenix, we came in 2010 to 2015. We were buying heavily when blood was in the street. Our thought there was Phoenix is the 5th largest city in the United States. It's not going anywhere. I didn't realize it was going to diversify so much in terms of employment and stuff, and come back so quickly, but it really did. It took years, but that's pretty quickly compared to where it was. I mean, rents were down 20%, and some apartment buildings were half empty, and housing prices got killed there because they were just the poster child for the housing boom and bust. Then in 2016, we went into Denver. We saw all the migration patterns of millennials and just so many young people moving there, and job growth, and just, the Four Seasons, and the cities just was already booming for a few years. But I'm like, wow, this is going to keep continuing. And it really has. Salt Lake City, we were so early there compared to our peers. It was not considered like a primary market or even a secondary market. It was sort of like a tertiary market. It's pretty small, but such a dynamic little town, very business friendly. Youngest, state in the nation in terms of population. We used to joke, they're like babies having babies. You see young people carrying babies. They speak multiple languages. You got Goldman Sachs' second largest office outside of Manhattan. We learned early on that was in Salt Lake, and fell in love with that market, bought around 1,000 units there. And then, we moved next to Reno. We were pre-Tesla on Reno. That might've been a little earlier. We got lucky on that one. We invested with a partner, a mentor and friend of mine, and we did very well there. The ones we didn't do well on were Texas, which we had 2 in San Antonio, about 600 units. They were older buildings. They had a lot of just deferred maintenance and issues. And during COVID, we got killed with collections. So we sold that when the market was hot. We got out for an 8 to 10 IRR, which was lower than our 12 to 14 or whatever we projected. But we were very happy to then redeploy that capital via 1031 into a much better asset. We were in Seattle for a hot minute, for a few years, with around 500 units. We sold those during COVID because of also collection issues. It was very anti, being able to collect rent there, and you don't have to pay your rent kind of thing. So we sold those, and same thing, 8 to 10 IRR, walked away with a single, and we're very happy. And then Albuquerque, New Mexico came about 5 years ago. We saw there was no new development in the pipeline, and we spent a lot of time out there, and we're like, this is a good market, slow and steady. During the last recession, very few buildings, if any, I don't think any, that were of size went back to the lenders and stuff. And they didn't see such great rent growth, but they didn't see the rents decline. And I'm like, okay, we're already 5, 6, 7 years into the cycle. Let's park some money here. And looking back, it was amazing. We started seeing some huge rent growth over the last couple of years. And even more importantly, it became more of a, I don't know if you call it primary market, but bigger investors started going there, like the Kennedy Wilsons of the world, and larger investors that before would redline that market, and they're like, no Albuquerque. They started investing there and drove cap rates down, which means the multiples up. We're like, here, you could take this building. It's a great building. I'm probably going to regret it 20 years from now. But at this time, we bought it at a 6+ cap. We're selling it at around a 3+ cap. Let's redeploy the market, redeploy into a higher barrier to entry market, Southern California versus, Breaking Bad territory. So Albuquerque was good to us. But that's we felt like a real good timing kind of market. And, we've since sold in Phoenix, unfortunately, everything in 2017 or 18. So we lost out on a lot of growth there, but that market right now is getting smacked. I think values are down around 20%, give or take. And there could be some blood in that market, especially with a lot of borrowers borrowing at very high leverage, floating rate term debt, especially if rents, they're already coming down. They're growing, but not at that crazy rate they were. If they flatline or decline, then there could be another big buying opportunity, in that market.
How do you think about the laws and regulations that are in California? I know you have over 2,000 units there. Sounds like you're buying another deal there right now. You've done a lot of deals there in the past. So clearly you're okay with it, but I'm curious about how you think about the regulatory environment and being a really tenant-friendly state, and how you think about that when you're investing.
Yeah, I think it's priced in. And if it wasn't priced in, it's all about risk-adjusted returns. So I think it's all priced in, and I'd rather take that risk at these great prices than park my money at nosebleed valuations like they were a few months ago in the Phoenixes and the Vegases and, the more boom and bust markets that are very transitory in terms of population. And there's such high barriers to entry here in Southern California, where we're buying a building now in Studio City in the valley, the best part of the valley, in my opinion. There's only been 3 buildings built over 100 units in the last 25 years. So it's so hard to add new properties and add to build, and everyone, like, entry-level housing is $2.5 million starting in Studio City. It's going to create people that just need a rent, and the rents are going to have upward pressure. And this particular building is not subject to LA rent control because of its age. It's a newer building. So it's a harder slog raising money because people read the headlines of California. I don't want to invest in California. I don't want to be part of the politics there, et cetera. But I've seen this story before, and it's long-term, I think 10 years from now, we're going to be 20 years from now, we're going to be so happy we own these kind of buildings versus, chasing yield in other markets that are more boom and bust and cyclical. And so that's why we sort of try to zig when others zag, especially if we are very bullish on an area like Southern California.
I've been pretty interested in starting my own nonprofit, and I've actually already received the legal 501c3 designation from the IRS. So I'm curious to learn a bit more about your nonprofit, the Resident Relief Foundation, and what you're doing with it. Tell me a little bit more about how it works.
Yeah, so we're seeing in our buildings that a lot of residents that have been there a long time, they fell on a hardship, unexpected job loss, some kind of medical bill, they weren't able to, make their rent for either a partial month rent or, for a few months. And we had to go through with the whole eviction and process and serve them because of fair housing laws. And we just couldn't pick and choose who we wanted to help and not help. And so we thought there has to be a win-win scenario. And we created Resident Relief Foundation, and we help identify residents from, across many people's portfolios that are good residents, and they've been in the building for, X period of time. And I think at first they couldn't have had a late payment. Now I think they can have some kind of late payment, but we give them financial literacy courses. We help them with resume building. We provide relief in the form of rent payment. The landlord sometimes drops the late fee portion of it, and we've given as little as a few $100s to help make a partial month rent, up to thousands of dollars to help people stay in their homes for multiple months. And it's a win for the landlord and for the management company because they don't have to have the huge expense of eviction and the downtime of a vacant unit and all the turn costs. All that added up are thousands and thousands, $10,000+ tens of thousands potentially. It's good for society because about 2/3 of these people didn't have any other places to go and would have been homeless. And homelessness is a huge issue and it's plaguing a lot of our cities. And it's obviously good for the person because it prevents them from being on the streets. And housing stability is so important in people's lives and psyches. And if they have that, then they could get on easier with their life and not have all the emotional issues and problems that not having a house or a roof over their head will provide. So we've helped hundreds of people stay in their homes, and we've saved probably taxpayers millions of dollars. It costs so much to build these units and stuff. And it's so hard to get help once you're on the streets, and it costs so much more. So might as well prevent people from being on the streets than allowing them to flounder. And so try to catch them earlier on in the process. And our goal is to get more foundations, very wealthy, family foundations and public support, and just be able to help thousands, and then 10,000, the more the merrier. There's a lot of people that are just responsible, just leading that paycheck to paycheck life and not, having any resources, and so we're trying to train them, but also give them a hand up in the process.
Are you able to use that on your own properties that you own?
We've done it, I think, once maybe out of the few hundred. I mean, we got to be careful with like self-dealing and stuff, that kind of thing.
I was gonna say, there's no conflict of interest there.
Yeah, exactly. So we originally called it Gelt Foundation, but then I'm like, you're alienating all the other owners and management companies. And yeah, it's literally just like, we're trying to do good in our industry. Without renters, we wouldn't have a business. So how do we help the industry as a whole and create a name for ourselves as being the founders of this awesome nonprofit? So we changed the name to Resident Relief Foundation. And, we've helped dozens of large management companies and other owner operators and hundreds of families that needed assistance.
I think it's really cool what you guys are doing. Keith, as we wrap up the show, I want to give you a chance to tell the audience where the best place is to go to find you and connect with you.
Yeah, I'd say we could jam on Twitter. That's my favorite medium, my favorite vice of all the social medias. And yeah, it's just Keith_Wasserman. You just search for compounding or Gelt or Keith, and you'll find me probably at the top of the list there. Or you could shoot me an email always. If it's a well thought out email, you can shoot me an email at keith@geltinc.com. It's GELTINC.com. And I'm here for anyone that's interested in doing what we're doing, investing in real estate, and or just long-term thinking and compounding. Those are things I'm sort of known for nowadays. So.
Keith, thanks so much for taking time out of your busy day to meet with me. I really appreciate it.
I think the biggest key here is what we hear all the time about investments is diversification, right? I don't want all my money inside of multifamily. I also don't want it all in self-storage. I don't want it all in car washes. I want to have this nice diversification across the board.